Good evening, everybody. It is December 21st, 2025, 12:40 p.m. And in today's video, I'm going to be going over my entry triggers. This video is made for many of you guys who have been asking, Halo, I want to learn more about how you enter trades and how you validate those entries. All right, so for you guys who are wondering how I do it, this video is for you. This video is also for all you individuals who've been wondering how you can go ahead and reduce your stop loss sizing, because that's a common question Fearing and I have both been getting asked the last few months. I would like to increase my risk to reward, but I don't want to compensate insane amounts of win rate to go ahead and achieve that risk to reward that I like to achieve. So many of you guys have been reducing your risk to reward size, or your stop loss size to be specific, going from 35 points to 20 points without any logic behind it. So just doing it off of intuition, you get stopped out and price goes to your TP and you're left wondering why. So this video is going to help you guys understand and engulf all your questions into one simple, I don't know how long this video is going to be, so I'm not going to put a timer on it, but we'll see how long it takes. All right. Hope you guys enjoy. So some foundational information that you guys all need to know before watching this video. As always, if you guys do not understand any of the concepts that I'm listing to the right side, to the right hand side, please watch and learn these concepts before watching this video. So leave the video, click off of it, go watch these concepts, come back, and then learn from what I'm teaching right now. All right. I also want to make a quick little disclaimer for anybody who's in or watching this video. Okay. If you want more examples of what I will be mentioning in this video, please, I recommend watching the daily recaps and reviews and tuning in to pre-market analysis, in which I cover all of these concepts. All right. So if any of you guys have any questions, if any of you guys have any concerns, watch those videos, or you can go ahead and ask me in the questions tab, or in your journals, or in the private chat, whichever one you guys would like, or through DM as well, if you guys want to go ahead and ask a private question. So some foundational information. The first concept you guys should all know, and if you struggle with it, ask: structure and narrative. Okay. Structure and narrative is the foundation of this whole scheme of my entry triggers. All right. Many of you guys ask, Halo, why do you take this trade? Structure and narrative. All right. This is one of the key pillars. Each of these holds their own importance, and I'll explain later. But structure and narrative is one of the key pillars you guys have in terms of understanding when and when not to take proper trades. All right. So structure and narrative is definitely up there on the list of importance. Okay. Next is true opens and NWOG and NDOGs. Okay. Many of you guys I see have a skewed understanding of true opens, either from watching ICT's videos regarding midnight opens and NWOG and NDOGs and saying, oh, you want to sell above and you want to buy below. That is a very vague understanding of true opens and NWOG and NDOGs and how they work. All right. Number 1 and 2 can coincide together and imply which trade you should be taking, right? Many of you guys are separating 1 and 2 and expecting them to work out on their own, which they both coincide in their own way, shape, or form. To go ahead and add more onto that, true opens, NWOG, and NDOGs. All right, the basic understanding of true open, NWOG, and NDOGs is skewed. All right, the whole concept of buying below and selling above, yes, that is a textbook example of what you should be doing. And in a perfect world, that's what you will be doing. But guess what? We don't live in a perfect world. And in most cases, you will not be getting the opportunity to short above a true open. And in many cases, you will be shorting under a true open, perhaps. And don't let that scare you, because if you have number 1, number 2 is simply just an added confluence for your trade. All right. Number 3 is cracks and correlations. Many of you guys know what cracks and correlations are. For those who don't, watch the crack and correlations video. There's a bunch of videos on crack and correlations on the WAP, sequential SMTs, premium discount, PSPs, PRCs, SMTFs, all the videos that you guys know and love. Those are all cracks and correlations. All right. And last one, but definitely not least, is patience. All right. Patience is one of the if not the most important one out of all of these. All right. And I don't mean patience in terms of price delivery. I mean patience in understanding when and when not to execute. Many of you guys think patience is, oh, I'm patient. And you start getting itchy and you say, no, I'm going to wait for my entry trigger to happen and then I'm going to execute. Patience in the sense that learning these entry triggers will take time, and building mental callus in terms of growing resistance to all those sentiment that you have of losing will take time. Remember that you guys are entering a new realm if you are going to be introducing this into your trading. Not many of you guys are going to feel comfortable doing it at first, but again, as I mentioned prior, building that mental callus will come from experience and time in the market. So the more you do it, the more comfortable you'll go ahead and be in terms of executing. All right. So 1, 2, 3, and 4, as I mentioned, have their own importance. You will see more throughout the video. So entry framework and trade validations, reactions and intermediate highs and lows with short-term high and low rates. All right. These are my two predominant entry parameters. All right. I have no other one. You want to include a CISD? It's most definitely supported by an intermediate high or low or short-term high or low, or a reaction off of a true open or time-based POI. All right, so we'll start off. Understanding. When evaluating trade entries, it is critical to understand that execution is the final step, not the starting point. There are several foundational components that must align for an entry to be even considered, right? Among the most important are overall market structure, as mentioned in the foundational information, number 1. The narrative driving price and the presence of Kraken correlations, right? So you have 1 and 3, both those pillars are showing in your key component of understanding that framework needed to validate your entries, all right? Entry should be the last variable addressed in the trading process. The initial focus must always be identifying a high probability point of interest, a POI, that is capable of being mitigated while remaining fully supported by structure with concepts such as sequential SMT, PRC, PSP, swing divergences, and a bunch other, right? These are just examples of cracks and correlations that can be used to validate or invalidate trade ideas. The ones you guys will be seeing me mention a lot are sequential SMT, PSPs, and PRCs. Swing divergencies, not specifically, because I have another way of entering those type of trades, right? So going ahead and continuing off of what I mentioned here, I want to sit here for a little bit and talk about the initial focus, right? Where your initial focus should be. A lot of you guys hop onto the market and think, I got to take a trade today. That mindset is supported by the idea of wanting to execute, wanting to find an entry. So what you are not doing, what you're doing is essentially looking for an entry. You're not looking for a trade. You're looking for an entry because you want that little hit of dopamine to then validate that you're in a trade, right? Again, switching your perspective, switching your mindset, right? Changing a little piece in your subconscious and saying, okay, I'm going to shift my thinking from entries to narrative and structure. And entries will be the last thing on my mind. You should be entering the day saying, let's see if I can get today's analysis correct. Take it day by day. And then by a week, you have a weekly analysis correct, right? That's why you guys don't see me do a lot of weekly outlooks and reviews, or weekly outlooks in specific of calling the future price in terms of, next week coming up, especially with high impact news. I have a structure of what I want to see price do and a draw on liquidity. That's all I have, right? And I take each day, day by day, and I'm willing to go ahead and annotate and move around accordingly depending on what is presented in the market. So should you guys. All right. So do not have entries as your number one priority in terms of trading. Entry should be the last thing on your conscious when you're looking to take a trade. All right. You have many variables you need to check off before you even get to that. All right. So entry framework and trade validation. This is a lot of words in this slide right here. I'm going to do my best. We might be in here for a little bit, but again, bear with me. So while individual traders may have a may have different ways of preferring, their hierarchy or weighting the specific cracks and correlations, right? The underlying principle remains unchanged. High quality trade opportunities consistently emerge when price is interacting with clear inefficiencies, dislocations, or confirmations within the market, right? So no matter what type of crack and correlation you prefer, again, me personally, I like sequential SMTs a lot as my primary one, and of course, crack and correlations amongst true opens as my secondary one. But whichever one you have backed by data and your preferred one is what you can use, right? Now, as I mentioned before, whether a trader chooses to emphasize sequential SMT, PSP, PRC, or swing divergences, the trade should be executed into or from an identifiable crack and correlation that provides objective validation. Now, keyword in this sentence, I'm not saying subjective, I'm saying objective. You need to emphasize that your trades, right, are supported by those cracks and correlations. You're either taking trade to or trade from, right? And it shouldn't be, I think it should be, okay, price is doing this, it's most likely going to do this after, right? Supported by the data you've collected alongside with your current market experience and intuition of where the market may proceed, right? Not off of hopes and dreams. That's not how you're going to make money in this market, all right? Plain and simple. So by restricting execution to setups that align with higher time frame order flow, traders effectively eliminate a significant portion of their low probability noise. How and what do I mean by this, right? Let me explain to you guys, right? Higher time frame alignments ensure that trades are positioned in the direction of institutional intent rather than short-term randomness. When this directional bias is further reinforced by cracks and correlations, the trade gains structural backing, narrative clarity, and measurable confluence. Many of you guys are too addicted to the low probability noise, right? Knowing your higher time frame draw, your narrative supported by structure, of course, right? Instead of trying to call the short-term moves that really are not supporting anything besides accumulations or confusion in your own mind, you will then have a more reinforced narrative of where price will go, all right? This approach not only improves win rate, but also enhances trade consistency and expectancy. Losses become more controlled, drawdown becomes more manageable, and decision-making more disciplined. Over time, this filtering process conditions you guys to operate selectively rather than reactively, resulting in a fewer trades taken, but a higher percentage of those trades meeting objective and a repeatable criteria. So again, piggybacking off of what I wrote here, it's very simple stuff. What you guys are going to be doing is placing restrictions on what you guys should be viewing in terms of structure, narrative, right? And having that support your overall idea, the cracks and correlations then support your overall narrative and structure that aligns. And then you take a trade accordingly with those parameters set in place, right? There's no ifs, ands, or buts. It's a repeatable criteria that gets rinsed and repeated continuously until profits are in your bank account, all right? Entry triggers and market conditions, right? There are numerous ways to validate entry triggers for everybody, all right? My two favorite ones are 10-point reactions off of time-based POIs and intermediate and short-term highs and lows, right? These entry triggers are not selected arbitrarily. The market dictates which entry mechanism is appropriate based on current condition, volatility, and price delivery. There is no discretionary picking and choosing involved. What do I mean by this, guys? I don't say one day, oh, I'm going to take a trade off of an intermediate or short-term high and low soup, and then tomorrow I'm going to take a trade off of a true open and then an NWOG, and then next day I'm going to take off of an NWOG, and then no, I don't do that, all right? It is simply based on what is presented. There are going to be days where I do 10-point reactions off of time-based POIs, true opens, NWOG, and dogs, and there's going to be days where I'm using intermediate terms, highs and lows consistently to go ahead and look for entries. But in many cases, what you're going to see me be doing is merging both of them together, right? And I'll show you guys an example later. There's an example actually right here at the image. I can't really zoom in. Hopefully you guys can be able to see this. Short-term high raid, short-term low raid, creating a crack and correlation, hitting a true open on ES. NQ mitigates that short-term low simultaneously, and then we see an impulsive move back up to buy side, initiating a buy program, right? So again, not picking and choosing, it's all dependent on what the market has to provide that day. A common misconception is that discretion plays a role in how entries are executed. In reality, the entire process from top-down analysis to execution is fully systematic. The only real discretionary part about this is knowing when to enter off those 10-point reactions, and I'll explain later. Right? There's a defined rule set to identifying trade opportunities and a separate but equally strict rule to set for executing them. Right? So it's not like, oh, I'm gonna use this one and then I'm gonna use this one. No, they're strict rules that I follow for both setting a narrative and structure and having an idea of what I want to see price do, alongside with entering trades. Both systematic, both hold the same value because both are very important in their own way. Right? If there is any uncertainty regarding price delivery, entry location, or profit targets, execution does not occur. And the ambiguity is treated as a disqualification. I don't go ahead and sit here and say, oh, I think I'm going to see TP here, or no, I have a TP in mind before I enter a trade. I have an entry in mind before I enter the trade of ideally where I want to see price mitigate before queuing me into the trade. And then I have usually an idea of where price is going to be my break even. Usually it's a 2 or 3 R. And then from there on out, everything is just rinse and repeat, right? The risk to reward is not always going to be the same, but there is always a threshold that it needs to meet. And that for me is a bare minimum of 2 to 1, right? Anything under that, no execution needed. Again, just noise in terms of market, that lower time frame noise that I don't need in my strategy. I don't need in my record. So I stick to high quality setup supported by the data I have provided for myself. All right. Example. So I mentioned in the top right before I go through this or I explain this example, right? Fractals will be referenced throughout this video. So if you lack understanding of the concept, please watch the WOT video. It is up there currently right now. Watch the WOT video or look at the questions tab within the questions tab or questions forum location and search up official fractal post and it'll pop up. Read through that little excerpt that I have written there, and then you guys have more or a deeper understanding of exactly what I do with fractals and how I utilize them for my entries and such, right? So here's an example, right? What is shown in this image is a prime example of a short-term low being rated, followed by a short-term high, which ignited the sell-off down to the fractal below. Prime example of using narrative with underlying structure to support a trade that validates the overall direction that the market went. What do I mean by this? Right, higher time frame BISI up here, 5-minute BISI gets mitigated, have a short-term rate of the low, short-term rate of the high, and then we see price move down and validate a move back down to the fractal range discount. Right, the fractal range, I'm not going to go over what fractal is in this video, as many of you guys already know what it is. I am going to tell you that fractals are a huge component of the overall trades I take, and it is the only thing I really use in terms of executions. Either I'm taking a trade from it or I'm taking a trade to it. So understand that fractals are a huge component of narrative and structure for me when it comes to executions. So the proper use of 10-point reactions. Here are just 2 images of 10-point reaction trades I ended up executing in the past month. Just 2 of them. I couldn't fit more in the chart or on the screen without interfering with the words. But here you have one, and here you have another. Right, short-term low on this one. This one was more of a continuation trade. So while 10-point reactions can provide a respectable win rate, they are not designed to be traded in isolation. What do I mean by isolation, right? You are not supposed to be pattern trading 10-point reactions. So this, in conjunction with being able to limit how many trades you take in a day, will provide you a barrier or boundaries in how many fuck-ups you can do. What do I mean by that? If I were to let you guys loose in a market with only 10-point reactions to go ahead and enter and nothing else, not even including fractals or intermediate term highs or short-term highs and lows, you will end up blowing your account very quickly, because 10-point reaction trades that go south usually go south in less than 5 seconds. So you will know relatively quick if you're going to be in profit or if you're going to be in drawdown for this trade. There's no real guessing per se, right? So when used alone, results tend to be suboptimal. As I mentioned prior, if you use nothing else besides 10-point reactions, you're not going to be getting a substantially high win rate, nor a substantially high risk-reward ratio, especially if you're targeting just, the swing high that's provided right above it or below it. Right? These reactions are not pattern-based setups. They are context-dependent and execution tools that must be paired with other forms of confluences, most notably the time-based POIs, which you guys already have seen me do. In terms of executions, I posted in my Outlook. I show you guys pre-market what I want to see price do. you're supposed to pair 10-point reactions with other concepts that I've already instilled that I've instilled in you guys in terms of the WOP videos, and then you'll get proper setups, right? Not every true open or NWOG or NDOG level will produce a high probability setup. It is your responsibility as a trader to validate these levels using structure, narrative, and price delivery before considering executions. All right. This is the only, and what I told you guys, the only discretionary part about this is knowing which ones will work. This is gonna go hand in hand with introducing intermediate and short-term highs and lows, or structure-based POIs. Right? Time-based POIs are one thing, structure-based POIs are another. They each hold their own importance, and you guys will see what I mean by that, right? When you have a low being rated and you have an NWOG right under that low in another asset class, you usually want to see, or for example, you see an intermediate term low on NQ, and ES is an NDOG sitting 5 points under it. NQ hits that intermediate term low, ES hits that NDOG, and now you have a reaction you can take place off of. Or why? You have your structure-based POI, you have your time-based POI, both hosting reactions that you would like to see in support of your structure, your narrative, and where you want to see price go to. So, second concept, intermediate and short-term highs and lows. All right, the same principle apply when using intermediate term and short-term highs and lows. These levels should not be traded mechanically or as a standalone pattern. They must align with a broader directional bias and according with your narrative and structure that is produced. Right? For example, in a bullish scenario, I provide this in the image to the right. Liquidity should be taking at a high, followed by a rate of the low, confirming a continuation to the upside. When combined with 10-point reactions and time-based POIs, this approach can yield a consistently strong win rate with a substantially high risk to reward, especially if you have higher time frame draws. This is very, very good. So what do I mean by this, right? You have a short-term high rate here on the NASDAQ. Then you have a 1-minute BISI. Again, this is a 15-second chart, by the way. Sorry for not clarifying that earlier, but you have a rate of the high mitigating a short-term high. Then you have a rate of this 1-minute BISI low, rate of this short-term low as well, rate of the 1-minute BISI high producing a 10-point reaction, which, by the way, just to go ahead and clarify real quick, I do want to say this, that this first reaction here would have stopped you out, and that's completely fine, right? This is not going to produce you a 95% win rate. You're probably going to get in the 70-somethings, all right? So your first trade might be a loss, and if it is, okay, take it. There's no problem with that. Your second trade, in this case, the mitigation of this short-term low within that 1-minute BISI after mitigating the 1-minute BISI high definitely can produce a high win rate. And that 10-point reaction yielded a substantially high risk to reward targeting external draws and liquidity. So your first loss of 10 points, take it, no problem. Guess what? You have a 7R trade waiting for you to happen after that short-term low is rated, and you just re-enter the trade. If you use this in conjunction with limiting the amount of trade you take in a day, you will really, it's very hard to lose in the long run, right? You can take, I mean, you guys have seen me take 4, 5 losses in a row, right? Where I'll lose 10, 12, 13, 15 points per trade and take 5 of them in a row, right? That's 60 points, and I make it back in a trade because the trade hit 120 points, or the trade hit, I don't know, 60 points, and I make that and double, right? So you guys need to understand that when it comes to the game of risk to reward and win rate, you need to let the probabilities play out. You cannot sit and marinate in those short-term drawdown periods where you're consistently taking L's, because you will end up fucking your mind over, and it will cost you, right? The wins will come. You better give it time. As long as you don't jam stop loss break even at unreasonable price points, and you don't trail your stops again at unreasonable price points, there's no need to worry about having a trade hitting break even, right? It usually is very instant in terms of direction. You might fluctuate here and there in terms of drawdown, or in terms of stop loss, or sorry, break even and then back up, and then break even and then back up. But that's very rare on the lower time frame, especially if you have the overall narrative correct and structure supporting it. It usually is just a beam right to your take profit. So don't need to worry about that. Now, last slide, right, in terms of the chart before I show you guys a live example that happened just this Friday. and hopefully you guys can ask questions later. So volatility adjustments and news considerations. This is a key component of this because I am definitely going to get asked this question for sure. And actually I ended up taking a pretty hefty loss because of it and not adjusting, right? So the methodology behind 10-point reactions must be adapted to prevailing volatility that the market provides. Market condition is not static. Ahead of high impact news events such as CPI, FOMC, volatility typically expands higher, right? So for example, a normal 1-minute candle may average 15 points. During elevated volatility, the same candle might even be 30 to 45 points per candle, right? So you need to adjust accordingly and know that instead of hosting a 10-point reaction, you might be looking at a 15-point reaction or a 20-point reaction. So reduce your sizing by half to adequate for that volatility that the market's being introduced, right? It is a trader's responsibility to adjust expectations and executions parameters accordingly. So this is your guys' job. Failing to account for volatility expands leads to misaligned entries, poor risk management, and reduced performance, as I mentioned before. The reason why I brought this up, okay, and the reason why I want to have this on this slide, or the last slide specifically, is because on a 1-minute candle, a 10-point reaction off of, let's say, normal volatility will usually give you the trade you want to see. If you're ahead of CPI, or if Trump puts tariffs on China again, and we have a 2,000-point drop on the Nasdaq, and each 1 point or each candle is 70, 80 points, you need to adjust, because what you may deem as a reaction that's valid and that it probably won't see your stop loss will most likely get mitigated 1 more time, or twice, or 3 more times. So you need to duplicate your stop loss average, right, to coincide with the overall volatility. So since this average or elevated volatility usually doubles the average point per candle size, you should go ahead and double your stop loss placement and reduce sizing by half. This was the mistake I made prior. Was I actually, on the day I lost 4.3K, I actually went in relatively heavy that day, and we had a pretty good expanding market. So I didn't adjust accordingly, and I ended up biting the bullet for that, right? Executions, last but not least, this is and I have this bolded for a reason. Executions are a byproduct of alignment, not anticipation, right? Executions are a byproduct of alignment, not anticipation. You will not be guessing where price will be going if you have everything lined up. You will not be assuming where your entries will be taken. You will just be executing on such. It would be obvious. It will not be any if, ands, or buts. You will have it there, and you will take it, and you will rinse and repeat it as need be until you produce the results you desire. When structure, narrative, POIs, and cracks and correlations are in agreement, the entry becomes obvious. If it does not, the trade is simply not taken. Okay? Very simple concept that you guys have to understand and engrave this into your mind and have this as a forefront of your mantra when you're looking for a trade, right? This right here. Now, let's take a look at the charts, right? So 90 hidden at the highs, and I want to go over this very briefly, right? 90-minute hidden at the highs, right? Which means what? We support a hourly fractal, right? So the 90-minute hidden was created at 10:35, right? In which YM closed above the previous 90-minute high body, and QE is still to do so, right? So 10:35 closes above on YM. We then have a 10 a.m. fractal, right? So I'm gonna have this microcycle hidden. I'm gonna have it here just to have it here, right? So the low of the fractal, this candle right here, so 10:25. Once you have the hidden in place at the highs, what does this mean? You will not be looking for a trade until when? Until 11, because this is an hourly fractal that's going to be formed. So from 10 a.m. to 10:59, you're expecting price to distribute lower and go down, not up. Now, when will you be looking for a trade? The first micro fails. The second micro, what happens? Raids at 11 a.m. on the dot, raids, and does what? Takes out the short-term low, sealing the fractal range, coinciding with what? You may ask. An NWOG. Time-based POI, 10-point reaction, long back up into OTE of the hourly fractal to the tick, reaction. Then price comes back down and then comes back up, ends up hitting the TP later in the day, right? So again, just a prime example of 10-point reactions with time-based POIs. Fairly simple concept to understand, nothing relatively impossible. And you also have I wouldn't say a short-term high, but a high being rated here on ES, true week open, validating a move back down on the NASDAQ. Then you have price come down, mitigate this low, and then come back up and then mitigate the high with the short-term high on the NASDAQ finally being hit. I hope you guys enjoyed the video. If there's any questions, comments, concerns you guys may possibly have, feel free to ask me and I'll gladly help you guys out. All right. There should be no part 2 for this video, but depending on how people are feeling or the questions that are asked, I might make one. I'll see you guys later. Peace out.